Hello, folks. It is Thursday, February 15th. It's about 9 o'clock in the evening on the west coast of the United States. In this video, I will be talking about gold and silver. We'll look at those charts. Let's jump right in. So this is COMEX gold. Front month is currently February 2024. COMEX price is about 2015 currently. And the precious metal is kind of hard to watch sometimes because they don't do anything, or they don't do they don't do what we wish they would do. Um, but positive stuff is still happening. Gold has risen above $2,000, and it appears that $2,000 is becoming a floor. Which would also suggest that if gold drops below $2,000, that's potential buying opportunity. And of course, when a gold drops down to its 200-day moving average, that's a possible buy point. So currently, we've got, I'd probably call that a double bottom around 2,000 level, which again, another suggestion that 2,000 could be a floor at this point. MACD just below the zero level, so bear mode, suggesting that the primary trend currently is to the downside, energy very low. So not a bullish chart, but basically gold just doing sideways action between 2000 and 2080 or so in COMEX. This is gold, spot gold, daily time frame. Not a lot of difference between the COMEX and this chart at this point. We're currently at 2003. So about $12 difference between the two vehicles, but same kind of action, just kind of sideways, slumping along. Here, the floor looks like it's just below $2,000, more like 1990. MACD in bear mode on a sell signal, energy very low. In the weekly time frame, let's move that picture. Again, sideways consolidation, potentially bottoming or finding support at the 2000 level, and could head higher from there. But if we look, we just got a new sell signal in this time frame, albeit MACD is in bull mode, which suggests that the primary trend currently in this time frame is to the downside, or to the upside, excuse me, bull mode to the upside. And note as well that we have a technical uptrend going on here. Low, high, higher low, higher high. And unless we drop below this low, we'll get a higher low, and then assumptively head off to the races to higher prices. So weekly time frame looked pretty good. Technical uptrend, MACD in bull mode. So nicer action in the weekly time frame. This is monthly. Note what's of most interest to me in this time frame is that it appears that gold broke above, this is about 1990, gold broke above that level and has pulled back to the breakout level to test it for support. Now, assuming that gold finds support at that level, again, the assumption is that it would then turn higher. I still have my pattern, my target, based on this flagpole pattern, flagpole pennant replication of the flagpole, 2550. So that's my current target in gold, 2550. Do we get there in 2024? Wouldn't surprise me in the least if that was the case, given everything that's going on both economically and geopolitically. MACD in bull mode, currently on buy signal, energy very elevated. So In the longer time frames, weekly and monthly, gold is looking fairly bullish, certainly not looking bearish. So COMEX silver, again, February 24 contract. Currently, silver's about $23 in COMEX. Note that the moving averages are in bearish alignment, 50 below the 200, 20 below the 50, which of course is not bullish, that's bearish. Although it appears that price has double bottomed. We got double bottom here, and apparently moving higher from that level. Had some nice volume on the last 2 days action. Of course, this session's currently in progress. MACD in bear mode, but on a fairly new buy signal. Looks like we got a buy signal, Tuesday, Wednesday. Energy is elevated. Let's see, daily spot, very similar, essentially the same chart. We go to the weekly silver chart. It appears that price is finding support along the lower median line of this shift pitchfork. These lower wicks on these candles, that's suggestive of bottoming action. MACD just below the 0 level, so bear mode on a sell signal. Energy is low, but again, we could make the argument that this is a technical uptrend going on here, although it's not as clean. This is basically a double top, so we didn't get a higher high here. We're getting higher lows as time progresses here, but we didn't get a higher high there. So not quite a technical uptrend, but close. The silver in the monthly time frame, just sideways action. Silver's waiting for gold to do something. Silver's going to follow gold higher. MACD in bull mode, primary trend to the upside, although all we're getting is sideways action currently. Got a couple of, so that's the charts of gold and silver at this point. Couple articles that were on Zero Hedge in the last couple of days. This was today. Gold shortage, that's always an interesting idea. People talking about gold shortage. What this article is referring to is that the current allocation, if we look at if we look at the financial assets, investable assets, what percentage of those assets is currently invested in gold? Well, it's only about 1%. It's actually less than 1%. And what this article is getting at is the idea that as investors, both individually and institutionally, followed the central banks into physical gold investment. Of course, the central bank, the non-Western central banks are buying gold hand over fist, Russia and China in particular. And so here we've got, if this 1% allocation merely doubled, so now 2%, we're talking about 2% of the $150 trillion in global savings. If the 1% jumps to 2%, we need 23,000 tons of physical gold. And that's 10% of all the gold mined in human history, and several years worth of production. As far as the gold that is mined in the ground, that's several years worth of production. So we could very quickly have a gold shortage, physical gold shortage, with just a slight change in investor sentiment towards the yellow metal. see if there's anything else. You know, governments printing money right and left. That's all of the Western governments and the non-Western governments as well. China's in a world of hurt. They're printing money. Russia's got a fiat currency. They're printing money. I mean, you know, everybody's printing money. That's what you do when you're running a fiat currency, because fiat currency is by definition the other side of debt. And so you create debt, you print fiat currency. Is there anything else in here? This is an idea. Central banks using their own paper money to buy gold. And why wouldn't you? I mean, if you or I had a printing press in our basement and we could print up, you know, currency that people actually thought had value, and all it cost us was paper and ink, it would make a lot of sense to take that worthless or nearly worthless paper and go buy physical stuff, whether it was gold, real estate, productive businesses, whatever. You know, if you can print money for essentially no cost and go buy real assets, why wouldn't you? And so some of the central banks, that's probably what they're doing to some extent, is they're using their own fiat currency to buy the gold while they can. So this is James Rickards from 2 days ago. What's he talking about here? Oh, see, this caught my attention. Headline CPA, 3.1%. Bullshit. Inflation is not 3%. Think about your experience in the last 12 months at the gas station, the grocery store, paying your insurance bills, paying for housing, you know, going on vacation, whatever, paying for automotive repairs, buying new tires, etc. Inflation is clearly higher than 3%. And so when we see numbers like this, of course, they come from the BLS, it just, at least for me, it just throws the ridiculousness of the BLS numbers in my face. My back? Oh, there's the mouse again. All right, I froze briefly there. I'll review the video and see what happened. Let's see, inflation is not gone. The Fed will not raise rates, but they will not be quick to cut them either because of inflation. And that's what I was saying yesterday or the day before. As long as inflation can be used as an excuse, I don't think the Fed will lower interest rates. Now, I have to caveat that with 2024 is an election year, and so it would not surprise me if the Fed did lower interest rates, but to do so, they will have to go to openly acknowledged quantitative easing. And in my opinion, the magnitude of that money printing, quantitative easing, would be 10 to 12 trillion dollars. I haven't said it for a while, but in the next 12 months or 10 months at this point, there is $7 trillion worth of US debt instruments that need to be rolled over. And of course, the only way they're going to roll that debt over is to print the money. There aren't organic investors who are going to buy $7 trillion worth of US debt instruments. It's simply not going to happen. And so that much money will be printed to buy those debt instruments. On top of that, we've got the government profligate spending, if I'm saying that word correctly. Basically, they're spending money hand over fist, and it's money they don't have. It's deficit spending. And so that money also has to be printed. In 2024, that's most likely 2 trillion, 3 trillion, something. And so now we're up to at least $10 trillion of fiat currency that needs to be printed. Now, if that money stays sequestered within the banking sector, it won't feed into inflation, but unlikely that will happen. Some of that 10 to 12 trillion dollars will leak out into the economy and further exacerbate inflation. So, because in my belief system, my understanding of economics and monetary matters, inflation is a direct result of money printing. And of course, that's what Milton Friedman taught. Um, yeah, inflation is directly related to money printing. Um, Good point here. Buying 50 different stocks is not diversification. They're all stocks. If the stock market tanks, um, a diversified portfolio that only consists of stocks, well, that's not diversification, because all of those stocks are likely to go down um, in a big meltdown of the stock market. So that's a good thought to keep in mind. And one of the reasons that people suggest alternative investments like gold, real estate, productive businesses, etc. Rickards is saying that, and this is a common theme in precious metals, is that all of us should have at least 10% of our investable assets allocated towards gold. He doesn't say physical gold. I would say 10% towards physical gold that you control. Now, if you want to invest in gold securities, ETFs, and the like, I would suggest that was on top of the 10%. 10% is the core physical precious metals that you control, and all other forms of precious metals are on top of that. Rickards is saying that 10% is enough that you'll make good money if the precious metals go up, and it's a small enough amount that your portfolio won't tank if gold goes down or just goes sideways forever. So anyway, that 10% is good advice. I got carried away. That's just me. I'm more on the throw another zero in there and you're looking at me. And of course, I would never recommend to anyone that they do that. It was a mistake for me to do it. I've seen some advisors recommend as high as 30%. If you're really an aggressive precious metal investor, 30% allocation of your portfolio. 10% I would describe as a minimum for insurance. And that's the point here. Gold should not dominate any portfolio. That's a mistake I made. My physical precious metals is the dominant proportion of my investment portfolio. Now I've done okay. I was buying physical silver back in the early 2000s. The least I ever paid for silver, I walked out the door, it was $4.85 an ounce. And so I was buying silver bullion at $4.85 an ounce. Most of the silver that I purchased was, in the $5 to $6 range. And so, I've done okay in the last 20 years. But again, I have and had too large allocation towards physical metals. So don't do that, but definitely protect yourself with physical precious metals. That's all I've got in this video. Just, protect yourself, folks. There's a lot going on. We've got economic challenges in front of us. We've got geopolitical challenges in front of us. It's an election year. Anyway, interesting things going on in our world. Take care of yourself. do what you feel is best for you. In my opinion, that involves holding physical precious metals in your own control. But that's a decision that you'll have to make for yourself. I can't offer financial advice. I'm not an investment advisor anymore. And that's all I got for you. I'll talk to you soon.